in an up and down session. We've got, meanwhile, the NASDAQ looking pretty strong today. It's adding 0.75%, 31 points to 4275. And finally, the S&P 500 up just a couple, so barely positive. 1841, Bill, is the level we're watching right now.
Let's talk about this market as we watch it drift this afternoon. In our closing bell exchange, we have Christine Short from S&P Capital IQ, Joe Tanius from J.P. Morgan Asset Management, Greg Sarian from Hightower, Hank Smith from Haverford Investments, and our own Rick Santelli. Everybody talk about cabin fever is what we got. Is that what the market's feeling right now, Christine? What's going to motivate the market to move one way or the other right now? What do you think?
You know, over the past week, we finally see earnings results making a difference in the S&P 500 index. As you saw for the first couple peak weeks of earnings season, the S&P continued to trade down. However, since February 6th, the markets are starting to recognize the respectable earnings growth of 7.8% that we're expecting at this point. That's going to be the highest earnings growth rate we've seen since the fourth quarter of 2011, so in over 2 years. So we're actually seeing the markets react to this positive news for the first time in a while.
Well, it was sort of bizarre last week to see markets have their best week yet of the year, even as some of the economic data kept landing with a thud, whether it was the retail sales report, industrial production. I'm sure over the weekend, people were looking at this Barron's front cover, talking about how the U.S. is going to grow 4%, forget about the weather, look through it. That's kind of, Hank, what it seems like markets are doing here. Are they right to do so?
I think the backdrop is positive. It's not nearly as positive as Barron says. We are going to have faster growth than we did in 2012 and 13, but it's still going to be below average. Data's still going to come in choppy and inconsistent, but guess what? The Fed is behind us for several more years with monetary policy. As the previous guest said, earnings are doing okay in this environment. Valuations are reasonable, if not attractive. You're getting great dividend increases. You're getting share buybacks. It pays to be bullish. It pays to be an equity owner in this environment.
But you're making the case based on Fed policy and not fundamentals. Is that what you're saying, Hank?
Oh, I would say both. Okay. Look, it's top line is 80% of S&P 500 companies outperformed on the top line, and the majority outperformed on the bottom line. So I think it's fundamentals and the Fed.
Joe Tanius, I know you watch the Fed very carefully. Even if they keep tapering, is that still going to be good for this stock market?
I think it is going to be good for the stock market. I mean, to echo, again, a lot of the same comments, the underlying fundamentals actually look quite good. You've got a resilient U.S. economy. Granted, the weather is clearly having an impact, but all that does is create some pent-up demand for the other end of it. You have corporate profits, which look quite good. And remember, the Fed is pulling back, off of the gas pedal. They're not necessarily slamming on the brakes. I think you have an environment where risk assets in the equity markets can actually do quite well over the coming months.
Hey, Joe, what about China? Because over the weekend, a lot of people are talking about saying, look, whatever the Fed does or doesn't do, China is, 36% of the global economy. It's where the marginal growth is coming from. They might be in the middle of a massive credit boom that they have to figure out how to either stop or clean up afterwards. And we know from prior experience here how difficult a position that could potentially be. So do you still want to be long everything, even with the support of Fed or what have you, when that remains such an area of important uncertainty?
I don't think I want to be long everything. I think I want to be very selective, especially with my exposure to the emerging markets. I mean, you mentioned China. Obviously, we've gotten quite a bit of data over the past week or so. It's been somewhat mixed. But remember, what's going on in China in this transition from an investment-driven growth engine towards consumption while trying to cool down the growth in credit, that's clearly going to have some execution risk. And I think we're seeing that play out in some of the numbers. But there are other countries in the emerging markets that I think can do well.
Greg Sarian, are you putting money to work right now? Are you buying anything?
You know, Bill, when I was with you in January, we talked about expecting more volatility in 2014. Last year was almost a straight shot up, and I think you're going to see this type of volatility throughout 2014. But as was mentioned, the Fed has our back here. This economic data being murky, some reports good, some reports bad, we see as a positive for the stock market because that means the Fed's going to be resilient. When Janet Yellen spoke a couple of weeks back, I think she reassured investors they're going to continue to taper because the data is getting more positive. Look at the M&A activity with Forest Labs today, Comcast buying Time Warner Cable last week. We think that's going to trickle down to the smaller companies because for every large company transaction that you're getting press about, there are a myriad of smaller companies being acquired by larger companies in areas like biotechnology and pharmaceuticals. We think this is going to be a real additive to the small cap market. We still like Europe right now, Bill and Kelly. We still think that the economic data in Europe is getting gradually better. We had a positive GDP number there in the fourth quarter, and Europe is coming out of the ashes.
Well, I'm just curious real quick. I mean, you talked about some of the deal-making activity and all of the cash the companies have at this point. What is the catalyst, do you think? Is it deal-making? Is it more dividends, more share buybacks? How do you see that evolving, Greg?
I think it's a couple things. Number one, these companies are making the same piddly returns that we are in cash. They want to put that money to work. They want to make investments. They want to grow their businesses, and they can do so by making smart acquisitions in great startup companies with great technology where they can save a lot of money on the R&D side on the back end.
Well, if it was good growth, though, if it was good growth, it would be put to work in areas. I remember all the M&A buyback talk before the credit crisis. You know, I think 2014 is already going to be the Roger Maris year. That's the way it's going in my book. There's more asterisks, you know, whether it's speed skating, whether it's weather, whether it's the taper, what's going on with Japan. You know, they're making Mario Draghi look like he has rubber bands. And all of this going on, and we still think that at the end of the day, that the Treasury market is wrong. Look at the following charts. You know, we were flirting with the lowest yield close in 6 trading days. It slightly reversed to 271, not under 270. But the next 2 charts are very important. If you look at the Dow versus the dollar-yen, the correlations, obviously we see what our stock market's doing, what the neat guy did yesterday. They're not really tracking. But look at it against 10-year note yields. I'll tell you what, I'm not sure how much the weather is going to impact the data, but what I can tell you is if the spread isn't awfully tight, there's a big adjustments for equities that's going to have to be made in the next several months.
Quickly, Rick, how could it not be about the weather? I mean, this weather has been relentless, as we know, in many parts of the country, and it's got to be the kind of weather that is stymieing commerce right now, don't you think?
Well, I think that we're going to probably sell less cars and maybe less houses, but I think the data shows us a bit more than that. And in those 2 areas in particular, there's nothing that's going to be lost. Any purchases that were going to be made ultimately will be made anyway.
All right. Thank you, folks. Appreciate your thoughts.
Good to see you guys.
On the markets today. You knew there was breaking news because Kate Kelly was